Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And the big news last week though was Super Microcomputer. It's given up all of its gain for this year, plunging 79% from the March peak, and it could be about to get worse. That's because the threat of delisting has now become the base case scenario, but the upside could be worth the risk with a potential 10x investment over the next few years. I'm going to detail why I'm still holding the stock and everything you need to know to make your own decision, along with some very important updates to shares of Realty Income and Medical Properties Trust. But first, if you've ever wondered what's in my portfolio or want to see all the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. I just started using it last year and love the app for getting ideas and sharing my portfolio. This isn't just another investing app though. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 150,000 investors in the social feed to see what everyone is talking about. I've shared my portfolio on the app and it's totally free to download, so look for the link I'll leave in the description and check that out. Back to our main topic though, and shares of Super Microcomputer, ticker SMCI, have had a hell of a ride this year. First up 355% to a split adjusted $123 a share in March, before crashing first on the Hindenburg short seller report, then when the company delayed its annual filing, and then most recently on news its accounting auditor was resigning to just under $28 a share on Friday. I started buying in at $45 in September before the split with about 300, now 3,000 shares, and have bought on the dips for a total of 5,500 shares at a price of about $38.83 each. But because of the risks I'm going to outline, I've sold call options against those purchases each time, selling call options expiring January 2026 with strike prices of $40 to $60 a share. This does cap my upside, but also lowers my cost basis to $29.56 a share because I collect that money on the calls. So again, it caps my return at what's actually still a pretty darn good 60 to 70% return on each of these times I bought the shares, but it really lowers my risk in these. So not to steal my own thunder here, I am still holding that position, but before you rush out to load up, there are some serious risks, and I do believe it's likely we're going to see one more big drop before the stock starts heading higher. I'll recap everything that's happened along with the analysis, why investors will need the patience, but also why when SMCI starts to recover, it could easily be a 5 or 10x return very quickly. Super Microcomputer was founded in 1993 by Charles Liang, who is still the CEO and owns the second largest chunk of shares after BlackRock, so more than 15% of the company is still owned by insiders. The company started making hardware components, but quickly evolved into making larger servers and even entire data center solutions, basically all the hardware built around those semiconductor chips that goes into a data center. And that's why SMCI blew up earlier this year. The explosion in demand for Nvidia chips and that AI computing power is being followed into the servers and the hardware needed for these data centers. While Dell and HP Enterprise also build those data center hardware, SMCI is a pure play on the theme, so investors are just following that money. SMCI revenue grew by 40% in the fiscal 2023 to $9 billion, is expected to post at almost $15 billion in 2024 for 63% growth, and as high as $30 billion, or double again in this fiscal year reporting. And the company has several clear advantages here over its peers. First, in its modular designs, where components within those server building blocks can be changed out so customers can, one, optimize their products for their needs, but also that Super Microcomputer has the flexibility to create new solutions around those modules just as soon as new chips are developed. SMCI is headquartered less than 10 miles from Nvidia in Silicon Valley, so there's no international geopolitics to get in the way of working together. As soon as Nvidia or AMD are out with a new chip, SMCI can be ready with a server solution. So with the rise of those computing needs in AI and that global data center build-out that's going to last throughout the decade at least, SMCI appeared to be the next big wave, possibly even the next Nvidia for investor returns, but then short seller Hindenburg dropped a bombshell. First, what you have to understand here, the grain of salt you have to take these with is understand that Hindenburg takes a short position in the stocks it targets, so has a huge position in seeing that price lower, even if it means stretching the analysis or the facts just a little bit. Its report revolves around 4 allegations: accounting manipulation, undisclosed related party transactions, sanctions violations, and rehiring executives caught in a 2018 case of accounting practices. I'm going to outline the allegations, then detail which are the biggest problem for SMCI. And the accounting manipulation allegations are probably the most severe, so I'm going to start there. This is similar to what happened in 2018 when the SEC fined the company $17.5 million for recognizing about $200 million in revenue early from its 2014 through 2017 periods. Without going all accounting nerd on you, basically the company was just moving forward revenue while delaying expenses in some quarters to make revenue and earnings look better. This was things like reporting revenue for contracted orders that hadn't been delivered yet, or delaying reporting some of those expenses. This is actually more common than you might imagine. Management at these publicly traded companies is under a huge amount of stress to make every quarter's numbers better than the last, so there are all kind of accounting shenanigans, some illegal and some just in kind of a gray area that are used. Us old-timers still remember the CDs mailed out by AOL in the 90s and how they were capitalizing those costs instead of expensing them to make their earnings look better, so I'm just trying to get around the accounting rules here. Hindenburg also claims to have uncovered a network of related party transactions that helps SMCI show higher profitability or margins than it would otherwise. It starts with a Taiwan manufacturer called Abelcom and its CEO Steve Lang. Yeah, the brother of SMCI CEO Charles. Steve owns about a third of Abelcom, and Charles and his wife hold another 10%, so this is basically just a very tightly controlled family-owned private company, and almost all of its revenue is from manufacturing components for SMCI. Also, in that same building as Abelcom in Taiwan is another company, CompuWare, which manufactures modules for SMCI. Again, almost all of its revenue from Supermicro. The CEO here, Bill Liang, another brother, while the CEO of Abelcom, Steve, owns about 37% of this company, and Abelcom itself owns about 15%, so this one is basically a subsidiary of Abelcom. Now the thing is, all these relationships have been reported by SMCI, and there's nothing illegal here. Apple itself has nearly 800 suppliers in 31 countries, and many of these rely almost completely on Apple for their revenue. Of course, it smacks of nepotism and self-dealing that the Liang family controls these companies, but SMCI products speak for themselves, and as long as this kind of relationships are disclosed in filings, it's all on the level. But then Hindenburg also alleges that another brother here, James Liang, owns 2 Taiwanese companies which have an undisclosed relationship with SMCI. Both of these companies operate out of that same building as Abelcom and CompuWare, which also happens to be named the Supermicro Science and Technology Park, so there might be some credibility to this one. The problem Hindenburg is trying to get at with these is that the private company transactions could be used to distort financials in favor of SMCI. The private companies would manufacture and then sell components to SMCI at a deep discount, basically taking losses for those, which would then allow Supermicro to make its gross margin profitability look higher. Since the private companies don't have to file those detailed financials, nobody would see where those losses are accruing. Next here, Hindenburg also claims that SMCI is violating sanctions against Russia by continuing to supply systems to the buyers within that country. A company called Niagara Computers out of Moscow was a big buyer of SMCI before the war. SMCI did stop working with the company when Russia invaded Ukraine, but Hindenburg alleges that other companies have been set up, one of them called Business Development International, that have acted as kind of fronts in the United States to buy from SMCI, then deliver products to Niagara and other Russian companies. The report only really shows circumstantial evidence like screenshots and pictures of people holding SMCI boxes, so it's a pretty weak allegation overall. Let's look at the fourth allegation, and then I'll show you why most of these are little or nothing to SMCI, but Hindenburg also alleges that some of the executives caught in that 2018 accounting practices scandal and removed from the company are once again associated through either direct hire or consulting. The report is surprisingly vague on the association or proof that these executives are there, but it's more just red meat for short sellers to try to drive that price lower. Of course, the question is then, do I think these allegations against SMCI are true? And some of them, yes, and some of them probably. But do I think even those that prove true are a threat to the company or its valuation? And the answer there is definitely no. CEO Lang has responded to the report, saying that it contains false and inaccurate statements and does not foresee any material changes that would be made to past financials. Now, of course, that's what every CEO says when this kind of thing happens, and the company still hasn't filed its annual 10K report, so I wanted to look further into each allegation. And first, the alleged rehiring or association with the 3 executives caught in the 2018 scandal. And this one is first because it's really a non-event for me. There's yet any proof that they're back with the company in any material form, or even if they are, who cares? Like I said, accounting gimmicks are used by every company. When management steps over a line, heads do roll and people get fired, but it doesn't necessarily mean those responsible weren't good assets for the company. So if the company wants to hire back good people, I say let them. Of course, the sanctions violations would be more serious, but there's as of yet no proof it's happening or that SMCI is complicit. Management does need to investigate this if buyers are acting to avoid those sanctions, but I doubt SMCI would directly risk its business for less than what amounted to $100 million in revenue over the last 2 years, a fraction of the almost $17 billion in total sales. With the related party transactions, especially the ones with Abelcom and CompuWare, those have been disclosed, and there's nothing illegal going on. There's no proof that there are other transactions with other Liang family-owned businesses, but I'm more apt to believe that this one is probably too, given that research. Again, though, it really amounts to just Hindenburg trying to make a mountain out of a molehill to profit from its short position, though, because these things happen a lot. Related party transactions, even undisclosed, are no proof of accounting shenanigans. SMCI gross margins have been falling over the last couple of years as the company prices its products aggressively to try to take more of that market share from Dell and HPE. If they were really hitting these third-party transactions to manipulate their margins, why not make the margins look even better? SMCI needs to fully disclose all of its related party transactions and does need to be more transparent, but there's nothing here illegal or that would amount to more than a wrist slap from regulators if it did happen. This final allegation, the accounting manipulation, that one's more severe, and that's where a smoking gun would come from if there is one, but even with this one, it's not an existential threat to the company or its leadership in one of the biggest growth themes in the market. Even when the company had to restate its revenue and earnings after the 2018 investigation, it really didn't change those overall numbers. Basically what was happening, SMCI just went back and moved the reported revenue in question from one quarter to the next or showed expenses in different quarters. The big problem, though, and this is where it really hurts, is that investigation into accounting practices and the time that it took to restate those reports that delayed the filing of the annual report, missing filing requirements by Nasdaq, and then resulted in the company's shares being delisted from the exchange. And that's where it appears that this could be happening again. We heard last week that the company's accounting auditor, Ernst & Young, raising concerns over the company's internal controls and practices, did resign from auditing those financial statements. So every company that files reports with the SEC for those publicly traded shares, they have to hire an auditor, an accounting firm, to look over those, make sure everything's transparent and follows accounting rules. And SMCI is now going to need to find a new auditor, and that's going to take time. Management is also working with a forensics accounting firm, kind of an accounting detective, to investigate those allegations and has to find a new auditor, but these things are going to take time, and that annual report is already late. It was supposed to be filed by August 29th. The company had 60 days from the missed filing to October 28th to contact Nasdaq with its plan to file its report and stay compliant. If Nasdaq accepts the plan, the company could have up to 180 days until February 25th of next year to file that 10K. Now, if the plan isn't accepted, or if SMCI didn't file a plan, then the stock will be delisted from the exchange and trade on the OTC, the over-the-counter exchange. Now, before you freak out on that, if this happens, investors still own the same amount of shares. Nothing really changes, though some platforms charge a higher fee for buying or selling OTC shares. Also, many institutional investors are prohibited from holding OTC stocks, so this is where you see the big drop in the price anytime a stock is threatened with delisting, or also just before it happens, as those big investors are forced to sell out their shares. Now again, none of this is certain, but the need to hire a new accounting firm does complicate that timeline, and there's a good chance the stock gets delisted. But like the allegations, it is not an existential threat to the company or its business. In fact, it has already happened before in 2018 when the company missed its filing deadline. The stock was delisted August 23rd when it failed to file that 10K due to the prior accounting fiasco. And looking at the stock history, we see a roughly 40% drop from June to the delisting in August, and then another drop in September, probably those institutional investors selling their remaining stakes. In all, from the 2018 peak to trough, it was a 53% drop in the stock. But then the company was able to fix its internal controls and accounting practices, took that $17 million fine by the SEC, and was relisted on the Nasdaq January 2020 at $2.91 each. And that means for patient investors, it was a 130% return just to wait 15 months. So following all this, what happens next for SMCI, and why do I think the valuation here makes this worth the risk? Now, earnings are set to come out Tuesday, November 5th. I'm really hoping management isn't reporting on election day so that everyone is going to be too distracted to notice, but the thought isn't outside the reality. It's here that we're going to get an update on the allegations, hiring a new accounting firm, and whether management can save the company from getting delisted. But I think the bigger picture is more important. Let's talk about valuation and why I think the shares are worth these risks here. Then I'm going to show you my strategy, what I'm doing with my stock. We can see in Morningstar data here that the stock is traded for about 0.5 times the revenue when it was relisted in 2020 and 2 times revenue last year. Now I've copied the actual revenue numbers here at the top for reference, so you can see that kind of strong growth over the last few years, growing sales by around 50% a year over the last 2. More recently, the stock is traded for a price of more than 6 times its revenue at that peak in March, and at around 2x multiple throughout the most of last year. Right now, the shares are a price of just over 1 times the last 12 months revenue. So what we have here is the market cap, which is the price of the per share times all the shares. That's the market cap divided by the revenue reported over the last 12 months. That's just over 1 times on a price to revenue basis. And if you apply those valuation multiples to the kind of runaway growth expected this year and next, you start to see what investors were watching earlier this year. On $28 billion in revenue expected for its fiscal 2025 reporting, even on the current valuation of about 1.2 times, that would be a $33 billion company, or about $56 a share. At the 2x revenue multiple where the stock traded at last year, it would be a $95 stock price, and just for shits and giggles here, at a 5x multiple, which is much more realistic of a valuation multiple for a company booking 50 to 100% sales growth a year, this would be a $140 billion company and a stock price around $239 a share. So you can see how the returns on this could go exponential very quickly. Now I know a lot of investors are already saying, yeah, but if it gets delisted, there's going to be another big drop, so I'm going to wait for that bottom to start buying. But you never really know where that bottom is going to be or if it's going to get delisted at all. It's already trading as if a delisting is on the way and already a strong buy on that valuation. Now, the facts behind all this remain. The data center build-out is going to develop over years, and it's going to mean hundreds of billions of dollars spent on that hardware that goes inside those. SMCI is a leader in this space, and none of the allegations change that. So the different outcomes we might see here. If they can avoid being delisted, we're going to see the stock surge higher by late January, which is why I'm not selling right now. I do think delisting is right now the base case, very likely outcome, so I want to wait before buying any more shares, waiting for one last big drop before picking up more shares and dollar cost averaging my position lower. If it is delisted, I'll hold my shares for the year or so that it takes to get relisted again and for this all to blow over. I think that valuation and the fact that this is the company to bank off that data center build out that is going to be going on for years again makes this all worth the risk. As it stands now with just my current positions, I'll make over $132,000 profit if the stock reaches my sold call option strikes by the January 2026 expiration. Or if it doesn't, I'll have lowered my cost down to under $30 a share. On even a 2x price to revenue multiple on $30 billion in sales, this is a $100 stock, which would be a 247% return just for having the patience to wait a couple of years. Now, all this being said, it may still not be right for all investors, especially those with a low tolerance for risk. And like any stock, I wouldn't suggest having more than 10% of your portfolio in this single stock because you never do know. The upside is worth the wait for me though, and I think for a lot of people out there. Looking now at stocks I'm watching this week, first up, Realty Income, ticker O, is going to be reporting after the close on Monday, and it's going to be hard pressed to put a positive spin on this business. While the monthly dividend REIT has started diversifying into industrial and gaming properties, 80% of annual rent is still from those freestanding retail properties, many of which have come under some hard times and are announcing massive closures. That includes Dollar General, Walgreens, CVS Pharmacy, and Dollar Tree, which together make up more than 11% of rents. While some of this has been baked into the shares, with the stock up just 2% this year, that level of closures recently announced by pharmacy and these dollar stores means it could be a while before a recovery comes for Realty Income. Also watching Barrick Gold, ticker GOLD, should have some good news waiting for investors on Thursday with expectations for 29% earnings growth to 31 cents a share on 19% revenue growth last quarter. I still don't think the market is priced in the upside for the gold miners, with shares of Barrick up just 19% over the last year versus a 38% run in the price of gold. Now Barrick should be able to leverage a sustained price of gold into even higher returns, and The stock is one of my favorite safety bets right now. Medical Properties Trust, ticker MPW, should be able to speak with more confidence than it's had in a long time when it reports earnings on Thursday. With the bankruptcy and dissolution of Steward now mostly in the rearview mirror and hospital operations looking stronger, the healthcare REIT is facing a much brighter future than it has in years. Investors may still be gun-shy though, as the shares still trade for cheaply at just 5 times on that price to FFO basis, half the valuations of peers in its industry. Giving you that bigger picture here with the Sector Spiders sector tracker, just 2 of the 11 stock sectors closed higher last week, with media names like Warner Brothers, Paramount, News Corp, and Comcast holding up that communication services sector. Now, these traditional media stocks have underperformed the market for the year, so earnings that were not quite as bad as expected probably helped shift that investor sentiment upwards. Looking at a longer trend here, the interest rate sensitive sectors like real estate and utilities especially have plunged with the rebound in interest rates. From a low of just 3.6% just before the September Fed rate cut, the 10-year Treasury has jumped back to 4.36% on fears of inflation next year. Over that 1-month period, real estate is down 3.25%, utilities are down 4%, and stocks in the consumer staples sector are down more than 3%, all having far out underperformed the 0.35% gain on the overall S&P 500 index. And at this point, it's difficult seeing rates going much further higher, while the Fed is lowering its own benchmark rate. Real estate stocks are still in very attractive territory, and other rate bets you might want to look at here are like the iShares 20-year Treasury ETF, that ticker TLT, are looking really smart here for a near-term swing lower in interest rates. Join me on the Blossom Social Investing app and see what everyone is talking about with the special invite link below, or click on the video to the right for the one dividend stock I'm buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.